we are going to open up with Tony Zhang telling us about openness, integration, and intentional monotheism.
Okay.
Take it away.
Good. Thank you, Shabnam. Thanks to the organizers. This has been fantastic conference so far. And yeah, looking forward to the second day. This is work with Tarek, and who's over there, Thomas, who's not here, and Jingye, who's also over there. Because Thomas at the San Francisco Fed, the usual disclaimers apply. Okay. Here we go. Oof. All right. So as we've been talking about, in recent years, the dollar's role as the world's anchor currency has come into a little bit of question. And in particular, we discussed yesterday how there was tariffs of the April 2025. These announcements, they led to some pretty weird market reactions. Dollar depreciated even though measures of global risk increased. We saw U.S. interest rates rise and U.S. stock market fell relative to the rest of the world. And so that background is the motivation for this analysis that we're going to present today. In this paper, we're going to try to do two things. One is we're going to try to perhaps better understand some of the economic forces underpinning the dollar's role, specifically as the linchpin of global finance. All right. And the second thing we're going to try to do, is to try to understand whether or not we can have policy tools that influence these forces and how they're available to Europe. And under what conditions could the euro emerge as the world's anchor currency? To start off our analysis, for the next 4 slides or so, I'm going to present a model that forms as the background to our analysis, the backbone of our analysis. It's a pretty standard model of exchange rate determination, and I'll lead you through the intuition of how it works. Essentially, the static model, there's 2 periods, t equals 1 and 2. There's a unit mass of households, and they're going to be split into n different countries. Countries are going to differ by how large they are. So theta n is a measure of how large countries are, and the U.S. is going to be special because it's going to be the largest economy in the world. Households are going to invest in the first period and consume in the second period. There we go. They consume a consumption bundle C, where the C is a basket of traded and non-traded goods. How do the traded goods and non-traded goods come into play? The non-traded good will be produced. Households own firms that produce this non-traded good. It's an AK production function, so you have this eta here, which is a productivity shock, as well as some capital that is installed. Each household is endowed with 1 unit of capital initially. It's freely shipped around in the first period, invested, installed, and it's used in production of the non-traded good. Traded goods. They are endowed, and they are homogeneous across all households, all countries. They're freely shipped around at any time, and they serve as a numeraire in this economy. So the state of the economy can be described in the second period by 2 shocks. One is this productivity shock that we showed on the previous slide, used in the production of the non-traded good. The other is a monetary shock, mu. You can think about this as a kind of inflation shock. How does it work? Households in each country, they're going to be split into 2 portions. There's the financiers with a measure psi, and consumers with a measure 1 minus psi. The consumers basically give all their wealth in the first period. They take all their wealth and give it to the financiers. The financiers take that wealth, they invest it into stocks and bonds, and in the second period, they're going to give some of that wealth back to the consumers. They're going to pay them a nominal bond, and the nominal bond payoff is Pn times this monetary shock. And so if you look at it closely, what you see is that if mu is very low, we interpret that as a low inflationary state, then the nominal bond payoff in real terms will be large. Okay? And so what that means is that this monetary shock redistributes wealth between consumers and financiers. And this is basically the same as having a demand shock. If the monetary shock is low, the inflation is low, the consumers are going to get a large payoff, and they're going to be able to consume more. They have higher demand. Okay. Households and firms are price takers. Markets are going to clear. These are the usual market clearing conditions for capital, traded goods, and non-traded goods. How do we solve the model? Well, to first order, so we just set up the social planners problem, take first order conditions, log linearize. Okay, the pretty standard stuff. What's the mechanism of exchange rate determination in our model? This is basically the important result here. Like most models of exchange rate determination that kind of follow the setup, what happens is that a currency of a country N, for example, is going to appreciate whenever local demand exceeds local supply. Okay. So how can that happen? It can happen if the productivity shock is particularly low and you have a low production of non-traded good, or if inflation surprises are low, the consumers are really rich and they want to consume a lot of goods. When you have this appreciation, in this states of the world, when you have this appreciation of your currency, you're also going to consume more traded goods, right? You want to consume, so where do you get these extra goods from? You're going to import them from the rest of the world. And so you can see here with your consumption of traded goods, if your production of non-traded goods is below average, or if your inflation is below average, you're going to import more goods. For notation purposes, this YM bar, this is the average shock that's hitting the world. Okay. However, because countries differ by size, the shocks of different countries are going to have different effects on the world price of traded goods. And the world price of traded goods also is going to serve as the stochastic discount factor to price assets in this economy. In particular, if you're the US, you're the largest country. If you have, say, a low inflation shock and your households are feeling particularly rich, so they're going to import more of the world's traded goods, well, because of how large the U.S. is, that's going to spill over more to the rest of the world, and that's going to drive the world price of traded goods up more. Okay, and so you can see that the impact of each country's shocks on the world price of traded goods is going to be determined by how large they are. Large countries have a larger impact. If you're a small country like Denmark and you have a high demand shock, that's great. You're gonna import some more traded goods, but because you're small, you have a pretty small effect on the world price of traded goods. What this mechanism does is it drives a strong covariance between the world price of traded goods and also the SDF with the exchange rate of the large countries in the world. In other words, the US dollar will appreciate whenever traded goods are expensive. Other currencies, less so. And so that underpins the asset pricing properties of this economy. The dollar ends up becoming the safest currency in the world because the US is large. Its currency has the highest covariance with the stochastic discount factor. And in particular, safety increases pretty generally with country size. As a result, larger economies are going to have lower interest rates. People are going to want to hold the dollar because it appreciates it precisely in those states of the world where the marginal utility from consumption is really high. And as a result, this also translates into higher values for US firms, and US firms are going to get more international investment. Why? Same logic. It's the dividends from these US firms are going to pay off in dollars, and dollars are really worth a lot because they hedge against consumption risk. Okay, so that serves as like kind of the baseline model. In a follow-up paper that we had in the 2023 in the restud, we asked, well, you have these large countries that have these safety properties to their currencies. Can smaller countries implement some policy to gain some of the nice properties that these large countries have? Can they do something to also make their currencies a little bit more safe? And we thought about this through the lens of exchange rate stabilization. So suppose you have a country M, and it gets two things to do now. It can choose a target to stabilize its exchange rate to, and it can also choose the degree of exchange rate stabilization. You can represent it here by this equation. So it makes its own exchange rate relative to some target country. It's going to shrink that volatility by some factor omega. If it shrinks that volatility all the way down to 0, that's like a hard peg. If it doesn't shrink its policy at all, that's like floating. Well, in this earlier paper, we show that there's both positive implications as well as normative implications. The positive implications are that if you do stabilize your currency to appropriate large target currency, you do import some of those risk properties, the safety properties of that larger currency. And that leads you to have lower interest rates and higher firm values, and it will attract capital investment from abroad. How does this work? You know, same, if you think like Denmark, Denmark is a small country, it's Danish kroner, if it, suppose it moves up and down freely, well, if it makes the krona move up and down exactly in line with the US dollar, then from the international investor perspective, there's no difference between the krona and the US dollar, and so I will be willing to hold more krona, I will be willing to invest more in Denmark. However, there's also normative implication. There's a cost to doing this. And as particularly, the cost is you're going to have to trade on world markets. And as the larger the country is, the more costly it's going to be to try to influence its exchange rate, because you're going to have to kind of work against, or potentially work against all the demand that's coming from your home, from the residents of your home country. And so for large countries, this ends up becoming a costly intervention. It's cheap for small countries. And so what you get out of this is that you can get the dollar-centric system that you observe in the world kind of endogenously. Whereas small countries, they're going to want to stabilize their exchange rate fully. Medium-sized countries will kind of want to have a loose stabilization, and the largest countries are going to want to float. But importantly, all the countries, they're going to want to stabilize to one currency in particular, and that's the currency of the largest economy. And so that's a quick summary of that paper. Having this theoretical background, we're going to try to operationalize this in a quantitative sense. And so in this paper today, we're going to calibrate our model to a 1984 to 2019 period, this period where world markets are relatively free, because we want to ultimately derive implications for how, what kind of policies Europe might want to adopt to promote the euro as an anchor currency. All right, so we start out by calibrating the model to do two things. We're going to try to match differences in interest rates across countries. So we're going to try to match a set of asset pricing moments. At the same time, we're going to try to match the world monetary order as it currently stands. So we're going to have an economy where it's optimal for small economies to stabilize heavily, so almost going to a hard peg. Medium-sized economies to stabilize a little bit less, and large economies are going to want to freely float. In the quantitative, and we're going to do some quantitative exercises later where we use, the state of the world as it currently is in terms of country size, and we'll get to that soon. And so the first result is, again, having this framework that I just described, we can basically match the current status of the world monetary order as it is. On the bottom here, on the x-axis, I'm plotting the sizes of the various economies in the world, binned into three buckets: small countries, medium-sized countries, and large countries. On the x-axis, I'm showing you how much do these countries and their currency stabilize to the US dollar. And what you see is that this line here is what's implied by our model as an optimal stabilization. The dots here are the data. And you indeed see that small countries, they stabilize quite a bit. Medium-sized countries stabilize a little bit less. And large countries, they're going to freely float. Exactly as our model endogenously, our model would describe. And so, as I mentioned before, with this framework, this dollar-centric system emerges from, endogenously, from individual optimality choices. All right, I have to go through one more piece of work that we did earlier this year, which is that how do we now tie it to modern day? In recent times, we have seen a rise of tariff policies, and in particular, you want to think back to April 2025. All right. What we got out of our framework is that the safety properties and the anchor currency properties of a currency are effectively determined by how large a country is. So what happens then if you see a country like the US impose tariffs on imports? Well, we do this formally within our framework by inserting a wedge between the home and world prices of traded goods. And essentially, before what I said was, a shock hitting the US, it spills over a lot to the rest of the world through the US consumption of traded goods. The US is going to, when the US has a low inflation shock, households in the US, they consume a lot, and so they're going to buy up a lot of the world's traded goods, and the world market price of traded goods goes up. When you insert a tariff that is dependent on how much the US consumes from the rest of the world, so you're taxing imports, essentially every shock on the US is now going to spill over to the rest of the world less. That makes the US systematically less important to the rest of the world. All right? It dampens the effect of US shocks on the world market. And from this country size perspective, basically having this trade world reduces the US's effective country size. As a result, the US dollar becomes less covaried, it covaries less with the world market price of traded goods. And from the view of an international investor, the dollar then becomes less safe. And it decreases the incentives for the rest of the world to stabilize the US dollar. Okay, so those are the economics that pin down the next set of analyses I'm going to do for the Europe in particular. In this next set of in our paper, we're going to think about 3 policy levers Europe can try to do to try to promote the euro as an international currency, or think about ways in which the euro can become more prominent as an international anchor currency. The first one, and we're also going to talk about these policies in the order that they're kind of in Europe's control. All right. So the first one is directly in European control, which is about integration. All right. As of today, Europe, the Eurozone, comprises about 15% of world GDP. And there's really 2 ways we can think about integration in the Euro area. One is real integration, and one is just promoting the adoption of the Euro across more countries. What do I mean by real integration? Well, you have different countries right now with different supply shocks and the like, and some are correlated, some might be non-correlated. So within our framework, we're going to try to think about, let's take all the Eurozone countries and let's make all their supply shocks perfectly correlated with each other, so that you can consider them kind of as one country as a whole. Euro adoption, that's a bit that's pretty more straightforward. It's like, suppose you have more countries now and you expand your monetary shock to cover a broader set of countries. And which countries are you going to think about? All right, so first you can think about first we're going to think about what happens if you just take the current set of Eurozone countries and you just make all their real shocks perfectly correlated. That's this deepening EU integration bar right here. You can see that you can raise the size of the Eurozone from 15% to about 17%. You can then think, what if you enlarge the EU? All right, there's a set of countries out there that both are willing to join the EU, or perhaps were a part of the EU and like the UK and disappeared, but then perhaps maybe they want to come back. All right, so you just expand the size of the European Union and you try to integrate those countries as well. And you can see that potentially can now increase the size of the Eurozone up to 0.22. And then what if you expand the euro even more to all of these countries? You can maybe expand the Eurozone up to 24% of world GDP. Okay, so these are 3 different levels of Eurozone integration that are potentially there. 2 things to point out. This by itself alone still does not make the Eurozone as large as the US. So by itself, it's not quite there yet. That's point 1. The second thing is that a lot of the gains from this integration is really coming from the real side. Expanding the monetary shocks to the euro to more countries is not necessarily the easiest way to expand the size of the Eurozone. What really matters seems to be that you want to try to make shocks more correlated across countries. So perhaps from the fiscal side. How do you get the euro to overtake the dollar? Well, part of this is now coming from the US side. In the US, we do have tariffs. And these tariffs are doing quite a bit to reduce the effective size of the US. What I'm showing here is a plot of, within our framework, of how safe a currency is, how correlated is a currency with the world market price of traded goods on the y-axis, plotted against the size of the tariffs that the US is imposing. All right. And what you can see here is that if you look at this thick black line, is that as the US imposes more and more tariffs, its currency is being viewed as less and less safe. US tariffs erode dollar safety. And as long as the Eurozone stays open, the euro is going to gain in safety as a consequence of that. As the Eurozone currently stands, the euro will our model forecast predicts that basically the euro overtakes the dollar if the US tariffs hit something like 26%. Right, that's at the current Eurozone state. However, if you go back to the previous slide and you think about the EU becoming larger, integrating more economies in the region, if we think about the EU enlargement scenario where the Eurozone starts incorporating all the other countries that have potentially expressed interest in joining the euro, then even at a 6% tariff, the euro overtakes the US as the most dominant anchor currency in the world. Okay, so a combination of having a larger euro plus the tariffs that are existing can drive the euro into becoming the most safe currency and can really incentivize other current countries to stabilize relative to the euro. This plot basically shows the same thing, but now from a welfare standpoint. So on the x-axis, we're taking the view of a small stabilizing country, and we're again plotting against the US tariff. You can see that floating for small countries, this dark black line is how optimal is it to float your exchange rate. The stabilizing relative to the dollar, those incentives decrease as the US imposes larger and larger tariffs, and so at some point you will want to switch over to stabilizing to the euro. And particularly, as long as the larger the Eurozone can make itself, the more those incentives are to stabilize to the euro, and this crossing over point becomes closer and closer to reality. Okay. Yes, in the interest of time, this kind of shows the same point in the same analysis. So I'm gonna move on. I will say that one more thing that I want to point out is that our analysis not only matters for the structure of the world monetary system, but they have pretty large fiscal effects as well. As we stated, when you become the world anchor currencies, if you're large enough to become the world anchor currency, your currency is viewed as safe and you're attracting international investment, your interest rates are going to decline. All right? And so one point of analysis we can show is that basically, given the change in, if you are the US, you are now imposing these tariffs. As a result, your currency is less attractive to the rest of the world and your interest rates go up. That has large effects on the fiscal side. We basically take the US debt outstanding, and if you increase the servicing costs, the interest rate on that debt by, say, 42 basis points, which is what's given by our analysis, that increases the annual interest bill by over $100 billion, $150 billion. For the Eurozone, as long as the Eurozone stays open, it's benefiting a little from the fact that the dollar is less attractive, and so countries are going to want to invest more in the Eurozone, and that lowers interest rates a little bit. That also lowers annual interest bills by a small amount. But if the Eurozone can enlarge and it can potentially take over the anchor currency status, that's going to lower the interest bill even more, up to 100 billion euros per year. And so this is coming from the safety premium channel that we've talked about, and so these effects we think are quite large. Okay. Perfect. All right. There's two caveats that we want to mention now in the last 5 minutes. First, all of this analysis hinges on the fact that the Eurozone needs to stay open. Okay. A common thing that we might think about is, Europe and America were friendly for the most part, and so suppose the Euro area and the U.S. teamed up and formed a transatlantic bloc where there was free trade within this bloc, but then we imposed tariffs on the rest of the world. The problem is that if you impose common external tariffs, you're effectively shielding the rest of the world. So any country that's not part of the U.S. or the Euro area from shocks that happen in this trade bloc. And so as a whole, this trade block becomes less important for the rest of the world, for world market price of traded good. And as a whole, both the US and the Eurozone are going to look less attractive as investment opportunities. So both currencies will lose safety. At 12% common tariff, which is what the tariff rates are in the US, you can see that interest rates are going to rise in both countries by like 20 to 30 basis points. And in particular, that opens the door now for third countries. And in this last bit, I'm going to talk a little bit about China. We haven't talked at all about China, and we keep talking about country size, and China is the second largest economy in the world. Why don't we talk about China? And the answer in particular is about capital controls. Okay. How do we think about capital controls within our framework? Essentially, the big picture is that capital controls basically behave like tariffs, but coming from the financial side. We all learned that when you have cross-border portfolio flows, they are the tools that finance trade flows. The capital account is the opposite of the current account, right? And so, formally, the way we model in our framework is that capital controls are kind of like a cap on the current account. Whatever amount of traded goods that you would like to import, if you're imposing capital controls, you're essentially shrinking the amount of traded goods that you're able to import by some factor. All right, and so we formally introduced this restriction in our framework to think about China, and we say that suppose Chinese imposes capital controls, essentially what they do is they're shrinking the amount of traded goods that they can import by some factor kappa. And if there's a fully closed capital account, then trade has to be balanced. You can't import or export at all. And so what you essentially see from this setup is that each capital control can be equivalent to some sort of tariff on Chinese imports and exports. And as a result, capital controls will shrink China's effective size exactly as tariffs would. And in particular, what we're showing here is that if we plot the effective size of China, how large China is, relative to some level of capital controls, very quickly, that's going to disqualify China as an anchor currency because the size of China is going to drop quite dramatically. The importance of China for the global economy drops quite quickly. At a fully open capital account, the effective size GDP share of China is at 17%, which is represented by this dot here. But as China increases capital controls, you can see this drop off. How do you properly calibrate this? It's a little bit more tricky because you have to operationalize. You have to try to measure capital controls. One way of thinking about this is this Chin-Ito index, which kind of tries to go around and tries to think about what types of capital controls are being implemented in various countries. And just to give out some numbers, the U.S. and Eurozone in this data set, they're at 1, meaning that they're freely open, whereas China is pretty close to the opposite end, meaning it's quite closed. So in our last bit of analysis, we thought, well, perhaps this forms as a risk. And yes, the Chinese, essentially China opening up its capital account can serve kind of as a risk to the euro or the dollar as an anchor currency. So we thought, well, if we think of a little bit ahead in the world and China continues on its path of growth, and suppose it finally overtook the US, it's now 30% of world GDP, and it also decides to fully open its economy, in that state of the world, then the renminbi can end up becoming the anchor currency. Okay. Is there anything that the rest of the world can do? One potential outcome is if somehow the US, the euro, and they included all the other countries in the world outside of China to kind of team together and implement tariffs on China, they kind of block out China from the rest of the world, then some level of tariffs will then recover the US dollar as a world anchor currency. So by blocking if it somehow implements a global tariff on China, that blocks out China, it weakens the renminbi anchor, and it restores the dollar. But those are the conditions. In that case, though, however, the euro will then still remain as a secondary anchor currency. Okay, I'm essentially out of time. So let me talk. This was a lot, so let me try to recap what's happening here. Essentially, we thought about this analysis kind of as a policy roadmap for the euro. We started off by presenting this like risk-based view of anchor currency status, and it's really grounded in two things. One is how large a country is, the size, and then also how open the economy is, because you need to be able to influence world prices of traded goods. You need to influence the rest of the world. And so there's three different policy levers that we thought about that can affect the effective size of the euro. And we presented them in order of European control. One is just integration and enlargement. Can you get other countries to sign up together, to join together with the rest of the euro area? That may be good enough on its own to promote the euro as an anchor currency, given the current state of the US imposing tariffs on the rest of the world and the fact that China imposes capital controls. The second is being trade openness. It's important that the euro area remains open because being open allows you to interact with the rest of the world, and it provides you with an advantage as the rest of the world closes off. And then the third point was about capital account openness. Currently, that serves kind of as a risk to the euro area. Chinese liberalization is an external risk, but it's what's kind of excluding the renminbi today as a potential anchor currency. And so we saw this have large effects both in determining the structure of the international monetary order, but then at the same time, the fiscal stakes are immediate and quite large because interest rate payments can be quite large. All right, thank you for your attention. I'm looking forward to the discussions.
Okay, thank you so much. Dima, Ken is the first discuss. 15 minutes.
Okay, I'll try to do my best. Okay, so thank you so much, Shebnem, for organizing this event and for inviting me for the opportunity to discuss this paper. I mean, effectively, I'm discussing not just one paper, I'm discussing a whole big research agenda, right? So, okay, Tarek Hassan, this opportunity to go back and understand many things that, I thought I understood, but I realized I didn't understand deeply enough. Okay, so just a very quick summary of this agenda, right? So it starts with two papers. The first one by Tarek, his job market paper about the effect of the size of the economy on the global stochastic discount factor, and through that on the risk premium that countries pay. Then the second paper about the incentives for other economies to peg to this currency. And then more recently, right, they have a paper talking about effects of US tariffs and how much that affects exorbitant privilege, decreases exorbitant privilege, and undermines the anchor status of the US dollar. So in a way, right, you can kind of summarize it using a picture, the following picture, right? So you have tariffs and capital controls as two policy instruments, right? For different, some other unrelated reasons, you impose these two constraints, these two instruments. They affect the effective size of the economy. That affects how global stochastic discount factor depends on your own shocks. That determines the risk premium, and in the end, that changes how much you pay at what interest rate you can borrow, and the anchor status of your currency. So now, what this paper brings, this fourth paper, right, brings to new. So it focuses on the role of the euro and under which conditions can the euro replace the dollar and also outcompete renminbi as the global currency, as the currency with the highest also safety premium. And so in the end, and I think so I read the draft and wrote my summary. Tony just showed his summary. It seems like it's exactly the same points, right? So in a way, what are the recommendations, practical recommendations for policymakers? First of all, the Eurozone needs to stay open to third countries. It needs to integrate more, and it's not just adopting the euro, but also kind of making fundamental shocks more aligned across countries. And finally, right, it kind of needs, luck or this exogenous shock, which it can't really control, that China keeps its capital controls, US imposes tariffs, and as a result, both the US dollar and renminbi cannot play this role. Okay, and in the end, right, this is kind of the main quantitative results. So that will decrease the interest at which Europe can borrow and economize about hundreds of billions of euros per year, and increase capital, wages, and GDP. Okay, good. So I thought I would prepare, a big picture discussion, but in the end, I got so interested into the mechanism that I ended up with a much more academic discussion. Sorry about that, but hopefully this will be useful, at least for some people in the room. So what I want to do, I want to go through 1, 2, and 4. Okay, I will not talk much about 3, but I want really to kind of dig deeper into these papers and understand how robust results are, what is the economic intuition. And just to preview, I think the first step, this effect of size on the risk premium, I mean, this is very robust, and I will show that even in other environments, which maybe I find more realistic, you still get the same result. The second result about the anchor status of the dollar, there I think the intuition, maybe my intuition at least is slightly different from how the paper explains it. And then finally, I will talk briefly about whether it's actually a good thing for the EU to become, for euro to become an anchor currency. Okay, so let me start with the kind of the foundation of the whole thing, right? The fact that size matters. So let me kind of strip down the model. So just leave the most basic ingredients, okay? So two economies, it's an endowment economy, no endogenous production. There is exogenous supply of tradable, non-tradable goods across states. Markets are complete. I will talk about implementation with particular portfolios later on, but for now, markets are complete. And preferences are the same as in the paper. I realize that I still use old notation relative to the presentation. This is a notation from the draft. So gamma is inverse of intertemporal elasticity, and tau is the share of tradables, kind of openness of the economy. And so given that this is a complete markets environment, there are no frictions, we can just solve the global planners problem, right? So what is the optimal allocation? I mean, clearly, consumption of non-tradables per capita is equal to the endowment. And so the only thing is how you allocate tradable goods. Solution is trivial, right? You just equalize marginal utility from tradable goods, and you can kind of solve it together with the resource constraint and get everything in closed form, okay? So there's this parameter alpha. I mean, you can already see that having gamma greater than 1 is important, right? So you want this intertemporal elasticity of substitution less than 1, while because of Cobb-Douglas, intratemporal elasticity is equal 1. And then you get this solution. And so here are kind of the main takeaways, right? So there are 3 potential output shocks. It can be non-tradable or tradable in each country. And it turns out that no matter which one goes down, it's always kind of a bad state of the world, right? So this is exactly what you get from this elasticity, is that the tradables, non-tradables, they enter stochastic discount factor in such a way that no matter which endowment goes down, you always get an increase in the SDF for tradable goods, right? So this is a bad state, but the response of the exchange rate will be different, right? So in particular, if it's an endowment of non-tradables in the home economy which goes down, their price goes up, so exchange rate, the domestic exchange rate, appreciates, right? If it's a foreign non-tradables which go down, their price will increase, and so real exchange rate will depreciate. And you can see, right, so in the first case, you can say that the home asset is safe, right, because it's a bad state of the world, and exchange rate appreciates. In the second case, actually, it's still a bad state of the world, but exchange rate depreciates. So in that sense, the home asset is risky. And in case of tradables, it's just neutral. You don't have any movements in the real exchange rate. So what you want, right? So how can you make the home asset being safe? Well, you need, the first shock to dominate, right? And that's exactly kind of captures the idea of the country size, right? So if US is larger, then theta, the kind of this parameter, Pareto weight effectively, it's higher, and so the non-tradables in the home economy will be the main driver of SDF, and so home assets will be safe. So you can think in this, oversimplified environment, how can you think about tariffs and capital controls? Well, I mean, the way they do it in the paper, it's much more kosher. They just put a wedge in the risk-sharing condition. I mean, in more reduced form, you can just think of this as decreasing of number of people participating in this global risk-sharing in the home economy, right? It's as if theta goes down, right? You just give local non-tradables to some of your home agents, and they don't participate in financial markets. They don't share the risk, and they don't kind of trade. And as you can see, right, as theta goes down, it kind of tilts SDF, the effect of the way SDF is determined, towards foreign endowment shocks, right? Domestic endowment shocks play smaller and smaller role, and so home asset becomes more risky, right? It loses this risk premium. Okay, so 2 kind of comments, questions, robustness. So the first one is that, I mean, in this model with tradables, not tradables, so they discuss tariffs, they discuss capital controls, but in a way, this is just the same thing, right? They're completely isomorphic. Both result in a wedge in this risk-sharing condition. It doesn't matter whether you can't ship the goods or you can't trade the assets. I think conceptually it's actually quite interesting. No, are these 2 policies really the same in terms of effects on the SDF? And here it seems like a more natural benchmark is something like Galli-Monticelli, right? So the model with home and foreign goods, where you can distinguish the 2 mechanisms, right? You can look, okay, in the interest of time, I will not do this very carefully, but in the end, so what you can do, right? You can write the, again, complete market risk-sharing condition, the market clearing for goods, right? Relative supply of goods, relative demand, and expenditure switching term. And then you have also net exports. And so you solve the model. I mean, the good news, robustness result, is that you get exactly the same effect. So if it's, if it's domestic good endowment which goes down, it's a bad state of the world, but exchange rate appreciates. If it's a foreign, you get the same effect on the SDF, but exchange rate depreciates. So, still goes through the intuition. And if you have more shocks in the home economy than in foreign economy, you still get that home asset is safe. But what is more interesting, what you can do in this exercise, you can distinguish these two limiting cases, right? You can look at trade autarky. It's as if countries cannot trade because of tariffs, right? So that corresponds to this tau parameter going to zero, openness of the economy going to zero. And you can separately look at the financial autarky, right? When you can't trade assets, and as a result, net exports has to be equal zero state by state. It turns out, again, qualitatively, under their parameter restrictions, it both work in the same direction. So it's true that you still have that risk premium goes, or safety premium goes down in both cases. But I think, maybe it's a work for the future to do this analysis more quantitative and maybe see if there are any interesting differences. It's also, my kind of wish, to do wish list for future research, not for this paper, I think is also to think more seriously about industrial policy, right? That's another thing that is now very widely discussed in policy circles. And so what are the implications? Is it just increasing the size of the economy? Or, for example, if you just shift resources from non-tradable sector to tradable sector, will that actually increase the safety premium? And it's not obvious, right? Again, in all these results that I showed you so far, it was more about non-tradables. The tradables actually don't play such a big role, your endowment of tradables. So maybe it's actually undermines safety premium. But so that's something to be discussed. Okay, and then another thing is that in the end, okay, do we really believe that endowments of tradables, non-tradables are the key drivers of exchanges? I think unconditioned, that's definitely not the case. There is a huge literature about Balassa-Samuelson effects, and okay, in the long run, it plays a role. Within monetary union, it plays a role. I think, for countries with floating exchange rates at higher frequencies, it doesn't play such a big role. But what is interesting is that even for kind of conventional shock, financial shock, you can actually get very similar results. Okay, again, let me go it very quickly. So you take the risk-sharing condition, you put financial shock, kind of risk-sharing wedge here. Let me abstract from endowment shocks. They're both zero. I still have market clearing conditions, but I will assume that foreign country is small, because otherwise countries are symmetric, and clearly, there is no reason why home should be safe. So the shock, right? The shock is kind of symmetric. It enters symmetrically into risk-sharing condition. So you solve the model, and interestingly, you get this result that the home asset is safe. And why does it happen here? Because home economy is closed, right? And all this risk-sharing wedge, in the end, it ends up in the consumption of foreign households. And so to hedge against this shock, they actually want to hold home asset, not foreign asset. Okay, and so and then you can do kind of the similar comparative statistics for tariffs and capital controls. So that, I think, is very good news, and I was very reassured when I saw this. Okay, now the second part. So what about anchor currency? And this is where I think things get a little bit more difficult. So we talked, I think, with Tarek before that, with other people, and the words kind of make sense, but I always felt like I don't understand really the result. And I think now finally I got it. So here is how it works. So think of us, again, static model is the same model, small open economy. Let me go back to non-tradables and tradables. But now let me take seriously how you implement this risk sharing, right? The portfolio choice. So there are only, Lucas trees for non-tradable goods, and countries, households, they can trade shares in these two Lucas trees. Okay, so this is, you have ex ante before uncertainty is realized, you choose positions A and A star in home and foreign assets with prices Q and Q star. And then in the second period, right, you collect dividends on these two assets, you get some endowment of tradable goods, and then you use this for spendings. There are foreign investors order equations, and there are market clearing conditions. And the planner can kind of, right, at the background, it can manipulate consumption of tradable goods. So that's, this can be FX interventions, it can be capital controls, other policies. Okay, so first result, and again, it's kind of makes sense, but I think it's an important benchmark. So if you take this model literally, the way I wrote it so far, and it's a model with complete markets effectively, so any interventions are suboptimal. It's already a first best economy, right? It's complete markets. There is no externality within the country to exploit. There is no terms of trade externality because it's a model with tradable goods. So in the end, there is, you can't improve welfare. There is no government intervention that would improve the welfare. I think that's the benchmark. But then the policy that they consider is the following, that suppose that portfolio is already chosen, right? Agents thought that there would be no policy intervention. They take some positions in two assets, then the policy is announced, and the policy here, think of this as a PEG, okay? And that creates valuation effects on these portfolios, and that kind of redistributes wealth across countries, right? And I mean, you can reinterpret that as kind of maybe more incomplete markets, but the idea basically is that there's kind of this unexpected policy announcement which creates valuation effects after the portfolio is chosen. Okay, I thought, okay, finally I understand this, but it turns out that that's not enough, right? Because if you think about this, so what they say, the country implements PEG, so now home currency looks very much like the currency of the large economy, so it gets this safety premium, so which means that the assets, the price of assets increases, right? But usually we think that if the price of home asset increases, it's actually a negative valuation effect, because part of home assets is held by foreigners, and if you increase that price, it's a valuation effects towards foreigners, right? That's, Helens and Pierre Olivier's original point in their paper. So that's not enough. So what happens here effectively is the small open economy takes long position in the local currency and short position in foreign currency. That's kind of a bit unusual, right? That's not how we usually think risk sharing works. So it's not just home bias, right? You need to hold more than 100% of your domestic asset and a negative position in the foreign currency. And then, of course, right, if you increase the value of domestic asset, because foreigners are short in that asset, you will create a redistribution towards your economy. But again, it's okay. So yeah, I guess I don't really have time to show this, so let me skip this, but okay. You can show this again in this toy model, you can show this in closed form, it's very nice. Let me instead just go to empirics. So is it really kind of a realistic thing? Well, I was actually surprised there are a few countries which have such positions, but it's about 7 countries out of 50 for which data is available, right? So you take foreign currency in assets and liabilities, and you compute this net exposure, and it turns out that for about 43 countries out of 50, so I guess 86%, you get that exposure to foreign currency is positive, not negative as in their model, right? And symmetrically, if you look at the position in the local currency, it's mostly negative, right? I mean, that's what I would expect, because I usually think about US portfolio. It turns out it's true for most countries. So I'm not completely sure how to kind of, is there a way to get realistic portfolios in the model and at the same time have the same mechanism? I thought about this a little bit. To me, it's just not obvious, right? But I think that this is an important thing to understand how the model works. It's not just, again, it would be naive to say that as long as you decrease the risk premium, that necessarily increases welfare. No, you need more than that, right? And the complete markets without externalities, that's not the case. You can manipulate your risk premium, you can make, risk premium negative, but it will not increase welfare. Okay, finally, my last slide. So what are the implications for Europe? Is it really kind of, all these things, is it kind of good news for Europe? Well, okay, so it's true that safety premium will probably increase for the EU, so the governments will borrow at lower rates. I mean, I don't know whether it's a good news. I'm skeptical. I think they need some fiscal discipline rather than facing lower interest rates. But more importantly, that the effects on welfare is ambiguous. Okay, and in some sense, I actually thought first that it would be negative because you exclude US, you exclude China from global risk sharing. It seems like for other countries, it should be bad news, right? There are less room for them to share risk. It's not necessarily the case. It really depends on how correlated shocks are across countries. You can construct examples where our shocks are so correlated that you actually like that other countries don't need this transfers in bad states of the world. But that's ambiguous, and it would be interesting to compute this in the model. Now, in terms of other countries using the euro as an anchor currency, this is where results are unambiguous, and they also say it in the paper, right? That's unambiguously lowers welfare of the EU, and also it dampens EU safety premium. Why? Well, because it's evaluation effect, right? It's evaluation effect from Europe to other countries. It can't be good for the EU. So I think you learn something from this model that you might get your currency as an anchor currency in the world, but actually you don't want that. I think that's an important takeaway from the paper. And so, to kind of conclude, I think it's not just this model. I think, I worked more with models where dollar is used as a currency of invoicing, and there you get the same results. It's very non-robust, or sometimes it's actually the opposite, counterintuitive result that actually it's bad for these countries to have their currencies used as a dominant currency. So I think it's ambiguous. What is not ambiguous, I think, is that both integration, openness, they have benefits on their own, right? It's kind of nice if they also maybe promote your currency in a way, allow country to borrow more cheaply, but this is second order and it's more ambiguous. I think direct effects of the integration and openness are more important. Thank you.
Thank you, Pierre. Deleu is our second discussant, 15 minutes.
Can I quickly just say something while you put the slides up? Because I think it's kind of complicated and it'll get lost later.
Sure,
Yeah.
but very quick, because you are going to get the chance to answer both
I
discussants.
understand. So the asset revaluations, I think, make more sense when you think about it in terms of stocks. Like, I am the monopoly supplier of my firms. And if you think about this in a dynamic world, like every period I can produce some firms and float them on the world market. And then you don't really need this kind of weird thing about the surprise and the weird bond holdings. But I agree with you that these... I'm not sure about that, but yeah, we can talk about it.
Okay, we'll discuss this later. All right.
Thank you. It's an honor to be part of this forum. It's a pleasure to read the paper and thinking through it. So the paper asks, under what condition would the euro emerge as the world anchor currency? That is the target currency that countries that PEG would choose. And the paper takes a risk-based perspective on exchange rate determination. Under this perspective, one insight is that the optimal anchor currency is the one that appreciates in global bad times. The paper also shows that it is, under some conditions, currencies of larger economies that tend to appreciate in global bad times. In fact, it's the currency of the largest economy that appreciate most on average in global bad times. And it follows that policies that expand the effective size of the EU or the euro area make the euro a safer currency in the sense of its covariance, and as a result increase the euro's prospect as an anchor currency. So after briefly summarizing the mechanism, I'll do two things. First, I'll propose a test and implement a test of the model mechanism based on the properties of the euro and the pound before and after Brexit, which was an episode of change in EU integration. And then I'll sort of step a little bit outside of the model and think about how other shocks and possibly other policies alter the stochastic property of the euro and affect this discussion about the potential of the euro as the anchor currency. So in a simpler version of the model with integrated markets and laissez-faire, the bilateral real exchange rate between home and the foreign economy is inversely proportional to the relative supply of non-traded goods. When the home non-traded goods deteriorate, the real exchange rate appreciate. Here the convention is that the real exchange rate increases. And that's meaning that the price of non-traded good at home will be larger than the price of the non-traded good abroad. Now in this model, obviously, a deterioration of a home non-traded good under some condition increases the demand for traded goods, increases the marginal utility of traded goods. And that's why the global stochastic discount factor, SDF, which is the marginal utility with respect to traded good, is also reflective of the country's non-traded good supply. And it's reflective of this non-traded good supply in proportion of the country size. When a large country non-traded good supply deteriorates, its exchange rate will appreciate, and this will also imply a large increase in the marginal utility of traded goods in the SDF. To the contrary, when a small country experiences a deterioration in non-traded goods, the effect on the global SDF is much smaller. And that implies that the covariance between the bilateral real exchange rate and the global SDF depends on the relative country size, home versus foreign. When a home country is bigger than a foreign country, the bilateral exchange rate appreciates in bad time. The currency of the larger country appreciates versus the smaller country in bad time on average, and vice versa, precisely because its shocks appreciate the home currency exchange rate, the home country exchange rate, and are more reflected in the global SDF than the one of the small economy. So I want to illustrate the way in which the authors interpret the process of integration or disintegration. In fact, I will do that in the context of an application to Brexit, the case in which the UK withdrew from the European Union. So in the model, the UK broad real exchange rate index depends on the UK supply of non-tradable goods in this simpler version of the model. And the way the authors interpret integration, or lack thereof, is that when the UK is integrated with the EU, its non-traded goods shocks are effectively the EU non-traded goods shocks. So there's a perfectly correlated shocks. And that's the case before Brexit. After Brexit, or after the effective withdrawal, the UK real shocks would be idiosyncratic and independent of EU shocks. Okay? So this simple observation leads to sort of three implications, three testable predictions. The first is that the pound is expected to depreciate more relative to the dollar in bad times after Brexit. In fact, so remember I said the covariance depends between the UK and the US exchange rate depend on the relative size, because the relative effective size of the UK has declined after Brexit. Its covariance is more negative with the global stochastic discount factor relative to the US. For the same reason, because the EU size has effectively declined with the exit of the UK, we should expect the euro to depreciate more relative to the dollar in global bad times after Brexit than beforehand. And in terms of pound versus dollar, you should expect something similar. The pound becomes a more riskier currency relative to the euro, I meant pound euro, after Brexit. In fact, you should expect the pound and the euro to move very tightly before Brexit as a result of their perfectly correlated shocks in the simpler version of the model. Okay, so I go to the data, and in particular, I take daily exchange rates, different currency pairs from 1999 to 2026. And the metric here of safety, which is sort of motivated by the paper, is the correlation in daily changes of a given exchange rate with daily changes in the VIX, which is my proxy for the global SDF. So here I first report the correlation between changes in the UK-US exchange rate, the correlation with the VIX. And what you can see is that indeed the correlation has significantly declined post-Brexit. That implies that when the VIX increases, the pound depreciates relative to the dollar more after Brexit than beforehand. So the pound has become a riskier currency relative to the US dollar. That has been the case also for the euro relative to the dollar, although to a lesser extent, which you would expect through the model, because the UK size is not a large portion of the EU size. And that implies that if you look at the pound-euro exchange rate, which would be the last set of bars, the pound started depreciating significantly relative to the euro when the VIX increases after Brexit relative to beforehand. So this is broadly supportive of the model predictions that indeed currency safety is increasing in country size. This figure focuses on the pound-euro exchange rate, and it's a 4-year rolling window regression of pound-euro exchange rate changes on changes in the VIX. What you can see is that before Brexit, the pound-euro exchange rate wasn't very responsive to changes in the VIX, which is consistent with the notion that it reflected correlated shocks between the UK and the EU. But afterwards, it decoupled, and it decoupled in such a way that is to be interpreted as the UK pound being more risky than the euro afterwards. Consistent with the model, you also have that UK 10-year bond yields are significantly larger after Brexit relative to the German counterpart than they used to be. And interestingly, and this is a bit outside of the model, but I think related, we started observing that UK exporters have started pricing their export in US dollar after Brexit more prevalently than before, which is intuitive if you think about the desirability or lack thereof of having your price sticky in a currency that depreciates in bad times. Okay, so the first point to me is that Brexit is an interesting example of change in integration, and I think that looking at the stochastic properties of the relevant currencies before and after, it's broadly supportive of the model ideas. My second point starts from the observation that in the model, shocks that raise the country marginal utility of traded goods are shocks that appreciate the home real exchange rate for a given country at a given size. Okay, and so for the sake of illustration, I want to consider another class of shocks, and in particular, I assume that the home country now faces relative demand shock between tradable and non-tradable. These are shocks that all of a sudden make the home country like tradable more than non-tradable. These are shocks that very naturally increase the marginal utility of traded goods and contemporaneously depreciate the home real exchange rate. So it's the opposite movement. And because they imply the opposite movement, they have the opposite effect on the covariance of the home real exchange rate with the global stochastic discount factor. Okay, so in this slide, the last term captures the contribution of these relative demand shocks to the overall covariance of interest. And as you can see, enter with a negative sign, they make the country currency riskier, the more prevalent they are. Moreover, as you can see, that term is scaled by size. Here, any shock is scaled by size. And so if the home country experiences large relative demand shocks and becomes bigger, this will make the currency more risky rather than less risky. Okay, and that's again because these are shocks that depreciate the currency and contemporaneously increase the SDF. Okay, so the opposite. Now, I want to say that I'm not particularly attached to these shocks. They're just time varying shares in the Cobb-Douglas aggregator, and I'm not saying these are particularly empirically relevant, but I want to say that thinking a little bit outside the model, I think it's conceivable that there are forces like financial forces that tend to depreciate the home exchange rate when the home marginal utility is high. This could be for a given country size. It could be like countercyclical sovereign risk, sudden stop, shocks that make domestic assets less attractive, precisely in global bad times, and so depreciate the exchange rate, making the country currency riskier. And unfortunately, I think these forces are not unfamiliar to the EU or the euro area. So the broader point is that if the euro depreciates in bad times for structural reasons, not just because of country size, then integration alone may not improve its safety properties, and in some sense, conceptually, it can be counterproductive. But the broader point is indeed that these policies of integration and enlargement may need to be complemented by policies that strengthen the euro safety properties. And in this sense, I think it's interesting to think about how other policies that are either discussed or implemented in the context of the EU and the euro debate affect the euro's properties, the euro stochastic properties. And for instance, it's interesting to think about eurobonds, and if designed a certain way, eurobonds would reduce the sensitivity of sovereign risk premia to the cycle, which would also be beneficial for the safety properties of the euro. And this is a potential benefit that goes above and beyond the eurobonds provision of a euro-denominated safe asset, which is another very relevant and important thing, but distinct. You can think about how asset purchase policies change the stochastic properties of the euros, it turns out that theoretically it's ambiguous. And again, I'm not saying that this policy should be designed to alter the stochastic properties of the euro. I'm saying these policies, which are designed for a number of stabilization reasons and risk sharing, they do alter the stochastic properties of the euro. And if you really embrace the notion that a key feature of an international currency is its covariance with the global SDF, its behavior during periods of heightened global risk, then I would say that it makes sense to consider how your broader macro policies affect that important metric. And so to conclude, I think the paper takes this risk-based perspective on exchange rate determination. I find it relevant, intuitive, in fact, fascinating way to think about equilibrium exchange rate and exchange rate policies. I think it helps explain the behavior of the pound and the euro before and after Brexit, which is quite interesting. But it also raises the question of, first, what are the set of shocks that we think are most prominent when it comes to euro and the euro area, and how do macro policies more broadly shape a country's safety properties, and as a result, its international borrowing cost and its potential to be the world anchor currency. To conclude, I think the euro may still have a long way to go to become the world anchor currency, but it is within the reach of EU policymakers to go in that direction. Thank you very much.
Okay, questions, please put your name up. Okay, I'm going to start there. Oh, Tommaso, where is your thingy? Okay, fine. So yeah, please follow the rules. Okay. Okay, you go.
Thank you.
Go ahead.
Very interesting paper. I have a few clarifying questions. One is, if I understood correctly, the paper is based on stabilizing the real exchange rate, which seems weird to me. It's an endogenous variable. Practice is very difficult. That's one. So if you can clarify that. Then, on a practical matter, if Europe would be the new reserve currency, would that imply that they'll have to run current account deficits? And the third one is also another clarifying question, is that when you think about the mapping of GDP size and financial debt deepness, what role does the network effect play? Because I tend to think that, maybe I'm wrong, but it's not the size of the economy, but the depth of the financial markets and the network effects that make you accept dollars even if you're not trading with the US. So if you can clarify how that works, that would be great.
Tommaso.
Okay, so thanks. I thought this was a really interesting paper, and the whole agenda looks very handy, especially for teaching. So and think about this issue. So I'm wondering. I have just one point. I'm wondering about global imbalances, right? So I'm wondering whether there is sort of an elephant in the room of this model, which per se should not have implications for global imbalances because it's static, right? But now, if I think back of the work of Quadrini, Mendoza on the equilibrium implications of financial integration, right? It seems that financial integration in this environment would generally generate an increase in global imbalances, right? So, and I'm not saying this is a dark side, because not necessarily. No, what I learned from Mendoza, Quadrini, and Rios' role is and work is that this is not per se negative, right? It's an equilibrium implication of basically smaller countries integrating with the large country and exporting precautionary savings, right? And the large country importing precautionary saving and issuing debt, right? But I guess it's an interesting to mention as a possible additional implication if the model were made dynamic, in a sense, yeah.
Murray?
Yeah, very interesting paper and presentation. I had 4 points to make. Nicola made the first one, which is, I guess, a natural one coming from the IMF. But I want to expand it a little bit. Particularly for small open economies, pegging the real exchange rate is going to be very hard. Most countries, when they peg the nominal exchange rate. If you're small and open, and this is a point that really comes from McKinnon in the 1960s, a lot more of your prices are linked to world markets, and so you just can't stabilize the real exchange rate in the way that you could maybe in the short run for a large economy with sticky prices. So I think that's a real issue. I think the number of countries that peg to the dollar is a very partial measure of the dollar's global role. It's of course related to the broader roles of the dollar, but it's the anchor currency role, but if you look at the roles in funding markets, in invoicing, all of those are much broader. And that brings me to my third point, that a large part of the covariance between the US economy and the world economy is driven by Fed policy and by this large global footprint of the dollar. It's not just that the US is large, but that's part of it. But there are many other elements there, including the depth of US financial markets. My last point is about the description of the effect of Chinese capital controls. It was kind of presented, if I understood, as a factor that reduces Chinese footprint in global trade, basically. But if we look at how China does implement capital controls, essentially they don't limit its effect on trade because they, the PBOC, state banks all act as financial intermediaries. So yes, there are controls on the private sector, but not on the public sector. And so China's footprint in global traded good markets is huge, and its capital controls don't affect that. They do affect its status as a global currency, because it denies China the advantages of open financial markets that the Eurozone has and that the dollar has.
Okay, great, Helen.
Thanks, great session with great presentation and discussions. So I have a few points. So some of them touched upon by Maury, but so I'm going to start with the risk sharing element of a model. So indeed, as was pointed out by Dima, so when you have shocks, it depends which shocks you have in order to get this real appreciation versus real depreciation of the exchange rate. So in order to get the real appreciation, you need to have a dominance of the non-traded shock in the US non-traded shock, which from a quantitative perspective, if you have a US economy which is 25% of world output, actually when you calibrate the model, you're not going to get that shock dominant. You are going to get other shocks dominating the co-movements. Now, as Maury just pointed out, however, maybe if you want to interpret size differently, which is the size of the US footprints on global capital markets, and if you do that and you are more in a kind of risk on, risk off global financial cycle style of idea, then you're going to get more action, I mean, quantitatively. But another thing which is kind of related is that if the US as issuer of a reserve currency is insuring the rest of the world, what it means is that in bad times, you should see resource transfers from the US to the rest of the world, which means essentially transfers of traded goods to the rest of the world, which is a kind of decrease in the US trade deficit, which in this risk sharing model is tied to real depreciation of the real exchange rate. So that's a difficulty that Matteo also pointed out in his paper, etc. So that's a kind of reserve currency kind of paradox, which is a bit hard to overcome in this kind of risk sharing model without additional friction. So that's one thing. But again, I think if there are ways of going around that, and if you think about size not as GDP size but as more financial market size, then I think that's probably does it for you. Another thing is that Maureen mentioned is that indeed the anchor currency and the risk-sharing view. I mean, as you know, I'm very sympathetic to that view as well. But indeed, it's a very kind of like silo views in a way of the role of the US dollar in the international economy, because the anchor currency role is tied to the reserves role, is tied to the invoicing role, is tied to the liquidity of various financial markets and trade volumes, etc. In a way, size plays also a role there in terms of network externalities, right? Liquidity, size goes to network externalities. On top of, there are other dimensions that are very important, such as fiscal stability and the role of the fiscal backing. And so a lot of these stylized facts about risk have also to be looked at from a point of view. So there's the liquidity dimension, but there's also the fiscal dimension, and some of the stylized facts on Brexit could also be interpreted in that, with that. The last thing I wanted to say about, from the point of view of the euro, is that what's a safe currency is that, in a way, it should appreciate in bad time, and also yields should go down in bad time under stress. And one of the fundamental issue of a euro area might not be, so much, going more towards more country, which I agree would help from a network externality point of view, but the financial architecture, right? If you have capital flight out of a periphery country to the core country, like the Bund, the spreads increasing, etc., in bad times, that really undermines the safety of Europe. And this is why a lot of the policy debate has been about how do you have a much bigger fiscal capacity, or how do you create a common safe asset, essentially.
Okay, great. So yes, you guys have, a little bit over 5 minutes to answer. Well, actually, no, you have more than that. Our break is at 11. We go to break at 11.
Okay.
Yeah.
Well, thank you very much. These were excellent discussions. Like, you guys really dug into the paper, and very good comments. Thank you very much. I wanted to hit, there's a lot of questions. I wanted to hit like kind of 3 macro points first. So let me first say, so I think the way that you should read this paper is not as a literal description of the world financial system, but more as essentially our first order approximation of it. So I should just point out that, like, we lack any equilibrium model currently that essentially replicates the architecture of the world financial system. This is our first shot. So in the sense that, like, the dollar's endogenously at the center, small countries stabilize, large countries float. So this is the framework that produces it. It's a highly stylized framework. So the way that I think we want you to read the paper is that the debate about dollar dominance is a lot about institutions. So, and there's a lot of important contributions in that debate that I don't want to minimize. But what we show with this line of research is that you can think about dollar dominance without thinking about the Fed, without thinking about international clearing, without thinking about which currency is oil denominated in when it passes the Strait of Hormuz. What are US banks doing? All these things might be important, but what we're showing here is that at the core of all of this, in a very basic economic model, this is basically the Becker-Smith model with bells and whistles, right? So in a very basic economic model, you get dollar dominance out of essentially 2 things: size and openness, if you want openness of the trade account and openness of the financial account. That's what you should take away from this paper. Not that all these other things are not important. So both discussants and also Helen kind of hit on of course, our theory rests on basically being approximately right about what moves exchange rates. And that is, as a profession, we're not super good at that question. And we're not really changing anything about that basic problem in our field with this paper. Pierre gave a very good example of, you can think of shocks that make you appreciate and reduce absorption at the same time. Those are not the normal shocks that we usually think about, but you can construct examples where when I appreciate, I import less. Normally in our models, pretty much any shock that makes you appreciate also makes you want to import more. And that's exactly the boundary. So if you think that on average, the shocks that move exchange rates are such that when you appreciate, you tend to import more, then our theory is going to work. If you think that we live in a world where there are other shocks that are like specifically about how much do I like the traded good today relative to other things and so forth, then the theory shouldn't work. But it has like some empirical support in the sense that it reproduces like the structure of the international monetary system and produces a bunch of predictions and asset prices, so it's not totally wrong, I guess. But that's the logical boundary. We had a lot of questions, both from Dima and in the discussion about the rationale for stabilization. And Dima, thank you for digging that far into the paper. I should say that like the fact that the normative behavior here in this model works out, and we get like without any frictions, basically. So I should kind of say, the only frictions that you need to get the dollar to be the anchor of the global monetary system is that the only assets that are traded are stocks and bonds. You don't get to have error-diverse securities. If you have error-diverse securities, then indeed nobody stabilizes their exchange rates. If you take away the error-diverse securities and the only thing you can trade is stocks and bonds, the model says that although the global social planner doesn't want anyone to stabilize, small countries will deviate and will just go ahead and stabilize. That's what the model says. Now, I think that's kind of a miracle, and we did not expect that to happen, and I don't think we actually necessarily believe this normative way. This is just like, in some sense, this got us past the Minnesota referees to sort of get the paper published. So in the first version of the paper, we made a different point, which is, if you stabilize your exchange rate, you get to lower your interest rate, you endogenously raise your wages, and you generate revenues at the central bank. And there's a large literature in political economies that like that is a policy that a policymaker likes, even if it would decrease national welfare. Now, so therefore, you know, so we love that this thing works out in equilibrium, and maybe now that we've written, like Tony maybe believes it more. Like, so we had lots of debates about like, you know, is it important that sort of like the you know, like in this sort of like, you know, white box version of the model, politicians like the national central planner actually wants to stabilize. So you can think of this model without the normative part in some sense by just writing a political economy version where I'd like my central bank to make money on average. I shouldn't talk too long. So, Helene,
Tarek, let me interrupt a little bit. What is important for us, of course, the euro side of the paper, the euro implication, and you know, maybe you can address some of those comments, especially from Helene but also Pierre and Dima.
Yes,
because that's important.
So I think what the paper suggests is that the way you become the anchor currency is openness, primarily. Maybe you also need a deep euro-denominated sovereign bond market, which, you know, I'm very sympathetic to, but the paper suggests there's an underlying fundamental, which is you want to be the heavyweight in the world economy.
You want to keep your maybe word, which is you just said you maybe they need a bond.
The model has nothing to say about that. There's no institutions, there's no Fed and so forth. So yeah, so but you know, the way I would read this is that the way that you synchronize your shocks is by having a common fiscal policy. Is that a controversial thing to say? I think that's like, you know, that's a way of integrating your economy by having by integrating the fiscal side. Yeah. No, again, I'm not against all these things, but it basically says, so there's not like a magical sort of you know, we're going to have a trade alliance here and there, and sort of like, but the fundamental, and I viewed it. So we have many theories of of currency dominance, right? All of them basically start with let's make either the dollar the safe currency exogenously, or let's have the dollar be the one with the lowest interest rate. And then you can write models where, like, you know, we're going to do currency invoicing in dollars, we're going to do all these other things in dollars. But in some sense, you need to start with basically where we end, which is you need to have a safe currency that is cheap to borrow in.
Let me just ask here, because if the, you know, the whole financial and the bond is out of the model and it is about openness and size, and let's just have the EU bigger and enlarge and all that, okay. But then, you know, that has to, you know, that is the implication of the model because it directly links to the correlation of the shocks and then integration, right? But then this, even you ignore the financial side, this goes back to the original optimal currency area literature with the endogeneity of the correlation of the shock to the integration itself.
Yeah.
So that has to be somehow addressed.
Yeah, so I think there's a very interesting, one interesting result that comes out of our calibration that we were trying to fight it. Nobody picked up on it, but like we were trying to make expanding the currency area more important than the real side integration, and it's impossible to do. So now you might say expanding the euro will harmonize stuff on the real side, which is what this literature is about. But essentially, the model really insists, our calibration really seems to insist on integrating the real shocks as the most important thing. Do you guys want to?
I arrived late. One small comment. I mean, there's a finance literature on size and why the largest guy wins, which is related to your endogenous prices, which is if you're larger, financial markets are, you know, there are lots of flows going on. And if you're larger, the price impact of those flows is much smaller, and therefore your endogenous becomes, say, Krishnamurti and he and many literatures like that.
Yeah, so I think our model is like so these models tend to need a coordination device. Yeah, so you start with two currencies, and one of them sort of like just has a deeper market. I view our model as basically being like, this is the coordination device. You're the largest one, so you're going to start out with the lowest interest rate, and now people are going to pile into that market. I think, but I do think it's important which view you take on this, right? So do we take a view that we can have basically do something on the financial side that kind of trumps these real considerations, right? So how important is this coordination device in the beginning?
It's a history dependence type issue. You were big at some point.
Yeah.
That gave you the deep market.
Yeah, so I like the Valchef, the Valchef and Tahir and Valchef paper for this, for example, where like you get locked in, right? So then there's sort of, and we have no, I think we're at the very beginning basically of having this debate, but basically the question is how big are the forces that lock you in? How big are the institutional forces that lock you in?
Okay, half an hour break. Let's keep talking and like be back at 11:30.